Welcome to Rogue Trader. Please read the disclaimer and remember that prices can go down as well as up. Hello and welcome to another Rogue Trader video, and today I'm taking a look at TotalEnergies. TotalEnergies are the world's 6th largest oil company, and by reference Shell are the 4th largest and BP the 10th largest. They're French but also listed on the FTSE. They've got so much cash swilling around that they're able to target 2 billion of share buybacks in the first half of 22, and they're paying a really nice 6% dividend. They're the world number 2 in liquefied natural gas, and that's 10% of the world market share. I'm a real fan of LNG investments, and Total are really well positioned in the LNG market. They're also the number 1 US liquefied natural gas exporter. They're also one of the top 10 players in oil refinery production and in petrochemicals. I went back as far as 2017 to find the first definition of their current strategy, and I really like their official strategy. Even back then they were saying that because of government policies, they expect that there's going to be a global electricity and energy shortage, and so their focus is mainly on selling electricity and liquefied natural gas. They're focusing on the entire LNG supply chain, plus the generation of electricity from gas and renewables, as well as in the trading and sale of gas and electricity. Core to their strategy has also been maintaining their current oil and gas upstream assets. So whereas Shell and BP have been mainly cutting back a lot of their assets in terms of oil and gas, TotalEnergies have been maintaining theirs since 2017. And where their growth is mainly where it's good to be, in the liquefied natural gas sector. They achieved 15 billion of net cash flow in 2021, and of this 50% of that is used for maintaining their current oil and gas exploration and production assets, whereas 25% goes to investing in renewables and 25% in LNG growth. So there's a schematic here from their annual report which highlights what they do. They're an oil and gas company. They do natural gas production, and then that's shipped over the world, where they have degasification plants and LNG networks where the gas is then supplied to customers. So they also have gas power stations in France and Spain, which produces electricity. They're developing renewables to also add to that electricity which they sell to customers. They have a lot of oil production assets which they refine into petrol and other petroleum products in their oil refineries. Then these either get sold to other people or sold to ordinary customers in their service station network. I've summarised their different business segments here according to revenues. The first is integrated gas, renewables and power. This is their LNG network, including production, sales and regasification. Also, renewables is added into this, as well as their gas power station assets and their gas and electricity sales. The second, at 17% of revenues, is their oil and gas production. They then have a refining and chemicals business segment, which is their oil refineries and their petrochemical plants, as well as they do a lot of oil trading as well. Now, 83% of their oil and gas production they actually sell to themselves within the refining and chemicals segment, and 24% of their revenues come from marketing and services. So this is their actual retail service stations, as well as their lubricants and the electric vehicle chargers that they're pushing. 24% of their revenues from refining and chemicals is actually them selling to themselves at their service stations. The way that they're selling to themselves, it's perhaps better to look at their profit by business segment. And we see that the integrated gas, renewables and power is 30% of their profits, with exploration and production 44%, and refining and chemicals 17%, with marketing and services 9%. Now they do have quite a lot of Russian assets. It's no way as bad as BP, who have about 50% of their reserves linked to Russia. But around 20% of TotalEnergies reserves are linked to Russia, and I've calculated that accounts for about 10% of their revenues and 20% of their profits each year. That's my very approximate calculation. So like I said, their official strategy goes all the way back to 2017, There's why I found it in their 2017 annual report. And so, unlike Shell, who only really updated their strategy last year, and BP, who did theirs, I believe, in 2019, way back to 2017, TotalEnergies were very clear on what they were doing, and they've kept at it. And I've been impressed, in particular, with the focus on LNG and the fact that they're maintaining their oil and gas upstream, not dismantling it like the others are to various degrees. The share price is currently still below just about where it was up till around 2019, and that's despite much higher oil and gas prices. So that looks quite promising right off the bat. There was the Corona crash, and then since then they've been rebounding. There's a few news items to mention here. The first is that they had their final investment decision for their Arctic LNG 2 project in Russia in 2019. So that was obviously a very bad move. In 2021, they acquired Fonroche Biogas, which accounts for 10% of French biogas. Now, actually, the French government is forcing the air industry so that 5% of their aviation fuel will have to be biojet fuel by 2030. And it is interesting how Total are refitting some of their refining assets to support biogas. In 2021, they had their name changed to TotalEnergies, and the biggest news story for them this year has been the invasion of Ukraine by Russia. TotalEnergies currently have the Yamal LNG project, which is exporting, and this is actually 28% of their current LNG production. As for their final investment decision in 2019, they also have this Arctic LNG 2 project, and this would have represented a 24% boost to their production. Their Russian interests are all owned by having a 19% stake in the company Novatek. Their Russian assets are 70% of their total hydrocarbon production, which is 30% of their gas resources and 24% of their proved reserves, and also 26% of their discounted future cash flows. When the invasion first happened, the UK government straight away all natural gas imports to the UK, and Shell and BP ran out and immediately cut off all their ties with Russia. Now, Shell don't actually have hardly any Russian assets, only 5 billion's worth, so they're not really affected. 50% of BP's oil and gas reserves are Russian. After cutting off all those assets, their hydrocarbon reserves are going to drop from 18 million barrels of oil to 9 million barrels of oil. So the Russian write-off is for BP, essentially them losing half their oil assets. And BP's Russian assets represent 35% of their market cap. So the Russia thing really is a total disaster for BP. With Total, however, the Russian these reserves are only 20% of TotalEnergies' total hydrocarbon reserves, and their Russian assets are worth about 10 billion, which is only 8% of their market cap. So these Russian connections really are quite a severe blow. So while the UK completely banned Russian gas as soon as the invasion happened, obviously the Europeans are desperate for gas because of their energy policies. So France and Germany basically said it was still okay to import gas. And in TotalEnergies' first RNS regarding the war in Ukraine, all they say is that they'll no longer provide capital for new projects in Russia. So this implied that although they would be losing out on their Arctic LNG assets and their future 24% boost to their LNG production, they'd still be merrily importing Russian LNG into Europe via their Yamal network. However, I understand that this created quite an uproar, and there were a load of protesters in TotalEnergies' Paris headquarters throwing a load of paint all around their head office. And then by the end of March, they seem to have changed their tune, and they came out with this RNS where they basically say they're going to walk away from all of their Russian connections, but it will take a year for some of that. They confirm here that their Arctic LNG 2 is dead, and that was about 24% of their future growth, according to me. They say that they're not going to sell all of their Russian assets now, but they're going to wait for all the dust to die down and hopefully get a better price for it all. But as far as I'm concerned, you can just write off all these 10 billion of assets. and they're going to stop buying all LNG from their Yamal facility by the end of year 2022. So this will mean a 28% drop, according to my calculations, in their LNG from next year. So there's no doubt about it, the Russian connection is a huge hit for TotalEnergies, but compared with BP, it's not catastrophic, only 8% hit of market cap, and it's a little bit of a blunted blow. They're still allowed to import until the end of the year, but then from next year they'll be totally free of Russian blood money. By the way, I think that overall Shell are better than TotalEnergies, because although they haven't got a strategy, and I love TotalEnergies' strategy, the depth of the Russian connection with TotalEnergies makes, for me, Shell a better oil investment, if only by default. And to summarize the Russian problem, the Russian connection is a real blow to TotalEnergies. And so if you're going to invest in TotalEnergies, they really need to have a strong case in all the other areas to overcome this Russian setback. So looking at the oil price, and we're back up to near record oil prices that we were last in around 2011 to 2015, we can see that in relation to the oil price, TotalEnergies share price does seem to mirror the oil price. Whereas there was this upwards channel for oil price, there was also an upwards channel here for the TotalEnergies price. And here we have the TotalEnergies share price in that channel. What was interesting in around January 2020 was this was when we saw lots of money flowing into the renewable stocks, and a lot of those had a 10x increase, and a lot of money was flowing out of the oil stocks. If you look at my Greta Gold video series I did, a lot of these renewable stocks really did pump up 10x around this time, and this was just all the money from the asset managers flowing into the renewable stocks. Since then, these have actually all crashed in what was clearly a bit of a bubble, and it's interesting to see all of this asset manager money float out of the oil stocks into those renewables, and now they're flowing out of the renewables and back into the oil stocks. So back to the oil price versus TotalEnergies, we can't always assume that the share price is always going to be just a function of the price of crude. And what we can say is that since January 2020, the oil price is up 46%, but the share price is down 8%. So to dig down into the different business segments, starting with integrated gas, renewables and power, and this contains liquefied natural gas production, sales and regasification, as well as the use of that gas in gas-fired power stations to generate power in Europe and a bit in America, and the sale of natural gas and electricity. Their strategy is all about LNG and in selling gas and electricity to people. They're the #1 US exporter of LNG, and that's really great because you see how much lower the Henry Hub gas price is to the other gas prices in Europe and Asia. And the price of gas has just gone up tremendously in the last year as we've entered into this energy crisis. We see here their LNG sales in million tons, and since 2017, according to that growth strategy, they've just been selling more and more and more LNG, which at these higher prices is amazing. This red line here marks from having to move away from their Russian assets, and that is a big hit, but they're still higher than they were 5 years ago, so it's maybe not so bad. In terms of the electricity production, you can see how they've been increasing their renewed installed capacity over the last 5 years, and they've actually even been buying gas powered stations in Europe, which I think is great. Interestingly, although their gas power stations are only half the gigawatt capacity of the renewable power, 86% of their current net power production in terms of terawatt hours, 86% of that is from those gas power stations. And that's because the gas power stations can be used at their full capacity all the time, whereas the renewable power, although the total capacity number looks higher, they can only actually function when the wind's blowing or when the sun's shining. So that explains why, despite the much lower number, 86% of their power they generate is still from those gas power stations. This is their global LNG portfolio, And in blue is the areas where they produce LNG, which then go through their liquefaction process. This gas then gets shipped all over the world, and you'll see that most of their regasification terminals, which is where they then sell the gas, is in Europe. You can see how they're exporting gas from places like from the US, where it's some of the cheapest in the world, and other areas of the world where it's less expensive, mainly to Europe, where gas is really expensive. Total have kind of a what I call a shotgun strategy, in which they will just operate anywhere in the world. It doesn't matter how down and dirty it is. Whereas BP and Shell tend to only go for clean cut and cotton wool nice places. Total really do go anywhere, and they kind of accept that there's going to be a certain rate of attrition. So for example, Yemen and Mozambique, they had to pull out of those in the last few years because of terrorist problems. Because they kind of go everywhere and accept a certain level of attrition, this does mean that their operating costs are much lower than all of the other oil majors. And so this shotgun strategy does seem to work for TotalEnergies. They've unfortunately lost their Russian assets in Yamal and the Arctic LNG2, and we have to accept quite a significant impact on their LNG as a result of that. Two areas that look particularly high risky to me are their Nigeria and their Papua New Guinea projects, but otherwise they've got strength in depth here, with a lot of assets all over the world with very low cost of production. I've gone through the last 3 years and recorded all of the main investments into their integrated gas segment, and you can print screen if you want to see every detail, but just to summarize, there's lots of LNG investments and actually also lots of renewable investments in this business segment that have been going on the last 3 years. It's a shotgun approach with low costs but high attrition. And we have to accept that the downfall of the Arctic 2 project plus the Yamal project is a big impact on their LNG growth for the next few years. And I've highlighted their Nigerian and Papua New Guinea assets as perhaps their riskiest that they still have. This is their renewables assets. So exploration and production are the next business segment I'm going to go into. So this is the exploration and production of oil and natural gas. BP's hydrocarbon reserves have been in gradual decline and are about to be cut in half because of their amount of investment in Russia. Shell's hydrocarbon reserves have been falling quite dramatically in recent years. Meanwhile, TotalEnergies have maintained their hydrocarbon reserves. In terms of hydrocarbon production, BP's has been falling a bit, and Shell's has also been in gradual decline. Whereas TotalEnergies have actually been increasing their hydrocarbon production and look in a very good position now, as we see record oil and gas prices. 59% of their reserves are in gas, which is a relatively high proportion, but however, we have to take away 70% of that as the Russian contribution. I recorded their investments in their exploration production segment. If you're more interested, you can print screen. But in general, a lot of the red stuff was actually their dodgier assets that they had to write off. Things like your Yemens and your Mozambiques. However, in general, the shotgun approach has enabled them to maintain their reserves in hydrocarbons with lower costs than everyone else, despite the attrition that they expect. However, overlaying that, the pullout from Russia is a sizable setback. This is the geolocation of their hydrocarbon resources, which you can print screen if you're interested. So now to look at their refining and chemicals segment. And they have crude oil refineries, and they also do petrochemicals production. And something else that they're adding to this is the biofuels units. So they've converted some of their refineries into what they call zero oil platforms. You take waste chip fat and vegetable oils and turn them into aviation fuel. And they're also repurposing some of their petrochemical plants to make biopolymers. So these are recycled plastics. We see that although their refinery capacity has remained fairly stable, the amount of refining they've been doing has actually dropped. And this was because of the high oil prices. They've actually had to shut down some of them because they became loss-making. And in terms of their petrochemical production, that's actually been in uptrend recently. Here we've got a map of all their refining assets, and most of their refineries are in the US or Europe. They also have petrochemical plants. Of interest is the Grand Puy Gardenville refinery, which they're converting into a zero oil platform. So in summary, they are maintaining a refining and petrochemical infrastructure, but they're repurposing some of it into biogas, biojet fuel. Their recycled plastic is of great interest. As can be seen from a few news articles I have found, there's a big market for recycled plastics, because all the big names, they want their plastic bottles and stuff to be made from recyclables, and so there's potentially quite a lot of business for Total here, because there's obviously, they still do their traditional plastic manufacture where you turn oil and gas into plastics very cheaply. With some of TotalEnergies' new operations, they're taking this recycled plastic, going through mechanical and chemical recycling, high value recycled plastics. If you buy an EV today, for example, that I'm sure is made with recycled plastics, which are a lot more expensive than was the case before. A lot of the expensive cosmetic brands and stuff, where they're charging $100 per unit, for them, they're quite happy to spend 3 times as much for the plastic bottle containing that perfume, because they can say it was used from recycled plastics. So I think this is a good area that Total are moving into. Here's a breakdown of their oil refining capacity, and their refined products are gasoline, aviation fuel, diesel, heavy fuels, and other products. I've got here an interesting breakdown of their petrochemicals. I can't really say I understand the chemistry here, but here it is. Okay, and to go into the marketing and services business segment, that's around 9% of their profits. This is their retail Total gas stations, of which they have around 15,500. And they also include their lubricants business into this segment, and things like the EV chargers and the hydrogen business. So I have a breakdown of their service stations here, and it's interesting that they do have a lot of service stations in Africa and Asia Pacific. That's actually the same as BP's strategy. In those places, there's going to still be a lot of people driving petrol cars for many years. And most of their service stations in Europe are in France. And I think they're going to be a big player in the French EV market with their EV charge stations. So there were lots of news items in the marketing and services segment, but a lot of them are really low value, so I couldn't be bothered to put them all down. In short, they are still investing in their retail and services segment. You can say that retail sales is still part of their long-term strategy, and in particular, they're wanting to be a big player in EV charge points in France. That completes my summary of the different business segments. It's clear from when I went into the details that they really are focusing on the integrated gas and renewables segment for their future growth, but the other segments are being maintained. I've got here a slide from their February 2022 investor presentation, and you can see how impressive the growth is in the LNG segment. Also in 2021, they had significant increase in their adjusted net income for exploration and production as well. From the same presentation, here's a slide where, again from their investor presentation, this slide shows how half of their capital investment is on maintaining their oil where it is, whereas a quarter is growing their renewables and electricity, and a quarter on LNG. They didn't mention their shotgun model in their investor presentation, but I think it's because of their shotgun model. They have the lowest operating costs of all of the oil majors. Onto their profit and loss. They've had a decent sales history up to 2019. Now, obviously, 2020, that was the Corona crash, and it's a bit of an anomaly. But when we compare 2019 with 2021, we saw that their sales were right back up again, and their operating profit was very impressive at 24 billion, with a net income of 16 billion. Their operating profit was up 50% and their net income up 45%, the pre-COVID numbers. So this does look very healthy, and we see a nice widening of the gap there between income and expenditure, and their net income rising very nicely. And yes, their revenues and profits have mainly been a function of the average yearly oil price. Now, general trends by business segment, and we see that most of their revenues are always from their refining and chemicals. A lot of the exploration and production sales are inter-segment, their refining and chemical sales, and 24% of their refining and chemical sales are selling to their own service stations for petrol at the pump. So this does complicate things a bit. When we look at their income by business segment, the COVID anomaly makes it a bit harder to see the trend, but most of their profits are coming from the exploration and production, and we can expect future growth in this because of the energy crisis and the increases in oil price. The general trend for refining chemicals has been a downtrend, and that's because the higher oil prices, whilst good for the production segment, is bad for their refining segment. And the marketing and services, which is their service stations, that seems to bring in a steady income every year and isn't so badly affected by oil price. So the main growth is exploration and production segment, but also in the orange line here we see that exactly as you'd think from their strategy, there's future growth here in their LNG sector. They're investing in LNG and in selling gas and electricity, and we do see the growth here quite impressively in the orange here in their integrated gas, renewables and power segment. They have a fairly stable asset and debt profile. Nothing really changes much in terms of the overall signature. The only thing noteworthy was they do have 50 billion of debt plus 43 billion of accrued liabilities. So now I don't really like this debt. Generally I hate companies that have debt, but actually comparing them to Shell and BP, they actually have less debt than either of those, and their gearing is only 15%, which is much lower than the gearing of Shell or BP. So maybe I can forgive that debt in light of this. The actual composition of their assets looks fairly good. It's about a third their actual exploration production properties and the capex supporting that, and a lot of it is current assets. Their inventories, which is all the barrels of oil in oil tankers around the world awaiting shipment, and cash. So I'm generally happy with the composition of their assets we see here, and they've got a price to book of 0.9 when I did this calculation, which is a couple of weeks ago. And so this is why they've got generally quite a nice equity and valuation profile, but I have to say it again, I don't like their debt there in relation to their overall market cap. Here's their consolidated statement of cash flows, and they brought in 30 billion from their operating activities plus a modest 1.8 billion from disposals. They spent half that, roughly 15.3 billion, on investments. They were able to pay 8.4 billion in dividends, 1.4 billion in share buybacks, and they used about 15 billion in paying off debt and paying off financial liabilities. So overall that was actually a 10 billion cash loss, paid off 15 billion of debt. So although it was a cash loss, that was on net actually paying off debt. And when I take away the things that they didn't have to do, we see that in a normal year, without them paying off debt, they would have a 6.7 billion cash gain. So I've now started using this new presentation for statement of cash flow to help picture where the money's coming from and where it's going. So here's their 30 billion of operating cash flow, which they took 10 billion from their coffers, but they've still got a reasonable amount left. And then here's their investments, which according to their key strategy, which I love so much, is maintaining their oil and gas exploration production to the same level, and then using a quarter of it to invest in renewables and a quarter to invest in LNG growth. And they were then quite clear, as you can see here visualized, able to pay these dividends and do some share buybacks, and then they did all of this paying off debt. So even normally, even without using some of their cash, you can see that they can quite comfortably keep up with their strategy and pay back their dividends higher than anyone else dividends, higher than Shell or BP dividends, and do some share buybacks, and they've still even got a bit of money to pay off debts. So here's their shareholder composition, and actually 8.5% of their shareholders are retail investors, and that's quite a high number compared with most of the stocks I typically look at. And also employees are also quite a high proportion, and I understand that they've got quite a large investment in their employees scheme where a lot of their employees have a lot of benefits from buying shares. Still though, the majority of the owners of shares are institutional shareholders and big asset managers. The only one who I know who they are is BlackRock. They're the only ones with a high enough percentage for it to show on my radar. And all these are unknown. Not so helpful really in this case, but there's the data I've got. So look at the sector analysis, and oil and gas, obviously it had all the money flood out of this sector, and then we move into an energy crisis and we see a nice pattern upwards. So I can only go 5 years back with the source I use, which is lclivecharts.co.uk. I am happy from a sector viewpoint with this where we are here. I've crudely drawn 2 potential long-term trends there. I think we're in an okay place to be putting your money in now. And potentially if we had this flight from oil and gas, but then, oh no, there's an energy crisis, and then all the money floods back into oil and gas, you could see them quite plausibly going back onto this commodity line up here. I found it very interesting that when I looked at aerospace and defence, the aerospace and defence profile matches the oil and gas profile quite nicely. And I found that very interesting because there are some people that say that Western governments only really bully other countries with their militaries to secure oil and gas assets, and so I find the overlay between oil and gas and defence very interesting. So here I've got the price to book versus price to earnings for different sectors. Farmers and IT stocks have much higher PB and PE ratios. In green here are all the commodity stocks, and apart from Ferexpo, who are based in Ukraine, TotalEnergies have the lowest price to earnings and price to book ratios of all of the commodities, apart from Rio Tinto. So that does make them look really good from this perspective. You're only going to invest in TotalEnergies if you believe that the oil price is set to increase over the next few years. I have high conviction that we're going to see elevated oil prices. I noticed actually the UK oil price is up 5.7% today, so that's nice. But I really do have high conviction that we're going to see a prolonged period of high oil and gas prices, and this is because of the energy crisis. And if you want to understand that, go and take a look at my commodities stock filter video series I did, where I go into why I think there's going to be an energy crisis in more detail. But even as far back as 2017, the disparity between supply and demand for oil, it's the International Energy Agency's data, and you can see despite COVID they expect oil demand to increase. Now over the last 5 years the Western government's been doing everything they can to punish oil and gas companies, punish people for using energy. And so there's been very little incentive for these oil and gas companies to invest in new future oil production. So we're in a situation where we're desperate for oil and gas. Now real people are suffering from high energy bills and high inflation. And so because of the government's mistakes, we can expect to see, I believe with high conviction, higher oil prices for quite a few years. That's why I think we've got this part covered in terms of the thesis for investing into TotalEnergies. I should state, however, one caveat, which is that if there was a big recession, so for example, because of hyperinflation, the governments have to increase interest rates suddenly, something like that could lead to a worldwide recession which would then crash the oil prices. As long as we don't have a total stock market collapse, I am expecting high elevated oil and gas prices for quite a few years to come. So now for a quick comparison of TotalEnergies with Shell and BP. TotalEnergies, I think, have got the best strategy of all of them, which is maintaining their current oil and gas whilst growing in renewables and LNG. And as we've seen from their statement of cash flows, they can afford to do this while still paying better dividends than Shell and BP, and even being able to pay off a little bit of debt every year. Now, BP's strategy is to reduce their oil and gas production by 40%. They're selling off 40 billion of oil and gas assets by 2025, and they're then going to use all this money to pay out big dividends, still not as good as Total, but 4% dividends, and do share buybacks. And BP's investment then is going to be in renewables and EV chargers in a bigger way, actually, probably than TotalEnergies. They're cutting in half all of their oil and gas stuff in order to pay the dividends. Now, the problem is that, as you can see here, they're relying on these disposals in order to do the dividends and share buybacks. And the problem is now that they've just lost half their oil and gas assets, now that BP have lost 50% of the oil and gas reserves because of the Russian connection, and they've lost 25 billion of their Russian related assets, which was 35% of their market cap. Because of this, in order to keep to this strategy, well, they've already lost half their assets. Then if they keep on doing this strategy, they'll end up a small minnow of a oil company. So I really do think that the Russian crisis is a total catastrophe for BP. And actually, despite this, BP share price is still roaring up. I think that their CEO is going to have to resign. I think that the write-downs are going to be enormous for this company. I don't understand why this is not reflected in their share price. Looking at Shell, they've actually been dithering along. They only did a proper new strategy last year. Shell had actually been discarding a lot of the oil and gas before, up to and around 2017, but they only really came out with a clear strategy last year. And their strategy is to modestly reduce the oil and gas assets by 15% by 2030. It brings them in some income from disposals. And they're kind of mildly investing into LNG and mildly doing renewables growth, and they seem to be having to invest into their refineries. But overall, it's kind of a bit of a mush, dithering along. They're kind of just staying the same, really. But Shell are the largest company, and they're a huge company. And so even though they've just been dithering along, in some ways they've done kind of well. They've got slightly more operating cash flow than TotalEnergies, which with their disposals ends up with more investments available than TotalEnergies, but that's actually half of that still maintaining their kind of larger base that they start with. They're paying out rather pathetic 3% dividends and doing a bit of share buybacks, but overall actually Shell, even though they've been dithering along and they're not really doing anything in terms of strategy, they're in a better kind of position of being 14 billion cash positive last year. And as you can see, that they've added their cash pile here from 18 billion to 32 billion. So actually, I think Total have the best strategy, but because of the Russian problem, by default, Shell are actually the better company to invest in, despite the pathetic 3% dividend. But the Shell share price is roaring up, but it's still below the pre-COVID level. As far as I'm concerned, BP is hell in a handcart, but it's still got a reasonably elevated share price. Total has been struggling a bit, and I can't help but think if this is because of the elections going on in France. And so I think that this may be affecting the French stocks, including TotalEnergies. Maybe wait until after the French election. Maybe you could invest now in the hope that when Macron wins the French election. So the Russian problem is a big problem before investing in TotalEnergies. This is definitely a big setback for TotalEnergies. But despite that, I can just about find them investable. The main reason is I think that their strategy has for a long time been very good, and I really like how they're positioned in LNG. They're greatly positioned to benefit from the energy crisis caused by Western government policies. They have a based strategy which has been ingrained since 2017, which is to maintain their oil and gas assets at the current level, not to reduce, and to focus growth in LNG and renewables, and also in the selling of LNG and electricity, including gas power stations. They are the #1 LNG exporter from the US, which I think is a very big feather in their cap. We have to accept that the exit from their Russian assets is a 20% hit to profits, and it's going to crimp their LNG growth plans. TotalEnergies' exposure to Russia is a big cross to bear, but it's not hell in a handcart if you're thinking of investing in BP. And I think Shell are actually the better overall. But if you can live with that, if you can live with a 25% hit, I think that TotalEnergies are investable because their overall strategy is so good. And I have high conviction of elevated oil and gas prices over the next several years. Shell are better by default, but only because of the Russian hit. Now, I've bought shares in both Shell and TotalEnergies, but if I could only buy shares in one, it would be Shell. Because even though they pay pathetic 3% dividends, I think the impact of the Russian risks make Shell the kind of default option, which is such a shame because I think TotalEnergies have a better strategy. In terms of risks, oil price is the main one, and if the thesis is wrong that we're going to have higher oil and energy prices in the coming years, that's a risk once you own shares in TotalEnergies. The main risk related to that would be if we have a proper inflation crisis, which leads to the central banks doing panic interest rate rises, that could then lead to a prolonged bear market in world equities. This would then affect the oil price. There's also the risk of environmental terrorism or pressure groups causing unfortunate legal actions. And also, I've said let's accept a 25% hit from these Russian exposure, but if I was wrong with that, that has got to be seen as a risk. Another one actually, which I didn't put here, is if there's, with any oil company, you've got to accept a risk of some kind of big environmental oil disaster. So if something like that happened, that's a risk you have to live with if you own oil or gas stocks. But overall, I think these slides say a lot from their company presentation. They have the cheapest cost to run assets of anybody. Their growth is amazing, and their strategy really has paid off with how good their growth has been, particularly in LNG, and they can afford to keep on doing what they're doing. Whereas that's perhaps questionable for some of the other oil companies. It could be worth waiting to after the French election and making sure Le Pen doesn't get in before investing. But apart from that, I think they generally are in a good time to invest now, but perhaps wait till after the French election first. So this concludes my analysis of TotalEnergies. I hope you've enjoyed my video, and good luck with your own investments.